Hi, and welcome to my monthly market insights video. My name is Dan Timitich. I'm a portfolio manager and managing principal over at T2 Asset Management. Before we get started, just to remind you, this video is for educational purposes only. The opinions expressed in this video are mine, do not reflect the opinions of other portfolio managers. You should always consult a financial advisor before making any investment decisions. Investments involve risk and are not guaranteed. Okay, what first half of 2020 was, and I'm pretty sure we can all say good riddance to that first half of the year. I could honestly say that this has been one of the craziest years of my career, and I've experienced a lot, including the bond bubble of '94, the collapse of the Thai baht, the Russian default fiasco, the tech bubble, 9/11, the financial crisis, and here we are with a global pandemic. But, we got through the first half, and as this chart here shows, the first half of 2020, it's clear that the markets just seemingly are shrugging off the catastrophic damage that's been done to the economy from the global shutdown. There have been some clear winners this year. Tech-related companies of the Nasdaq, it's really the only major market index that's been positive this year, followed by the aggregate bond index, the overall bond market. The junk bond market, however, was down, as was the Dow Jones Industrial Average, the S&P 500, and small caps. The second half of the year, I'm sure, is just going to be as interesting as the first half. So let's take a look and see what the month of June looked like. Here we have the chart, and as you can see, most major markets did quite well, with only junk bonds having a negative month. However, as you can see, June was anything but a smooth ride. We had a great start to the month, followed by a big sell-off, and then another small rebound from the June 11th bottom to finish off the month. Looking at the quarter, you would think that we were completely out of the woods. We just had the best quarter since 1998, and for perspective, that was during the tech bubble. That said, the market returns for the quarter would rank among the best annual numbers for these markets. As an example, over the last 30 years, the S&P 500 has only had 9 years where the annual return was over 20%, and yet it had a 20% return in just a single quarter. Another example, over the last 30 years, the Nasdaq has only had 8 years where the annual return was over 30%, and yet again, it had a 30% return in just a single quarter. It's pretty clear to me that the market recovery in the second quarter was fueled by the Fed, as well as speculators looking toward a very, very optimistic third and fourth quarters. I did put out a note to clients around mid-June talking about many of these factors. So if you're interested in reading it, just send me an email. I'll be sure to get it to you. Now, when we look at the S&P 500 index, I think it's important that you know that it's comprised of 11 different sectors. Here you can see that only 3 sectors were positive for the year: consumer discretionary, communication services, and technology. All the remaining 8 sectors were negative for the year. It's also important, I think, to remember that not all these sectors carry the same weight in the S&P 500. As you can see, the 3 sectors that had positive returns for the last 6 months represent about 47% of the index. The remaining 53% was all negative. With the S&P 500 being cap weighted, clearly the largest companies of the index are driving the index. So let's take a look at what the top 5 companies in the index look like: Microsoft, Apple, Amazon, Google, which includes both shares, ANC, and Facebook. The top 5 stocks represent about 22% of the S&P 500, and they contributed nearly 6% of the return to the index. Doing a little bit of math, the remaining 495 companies had a combined loss of about 13%. The point here is that the so-called rally is not broad-based. Any positive performance for the S&P 500 has been driven by very few companies, and investors that aren't paying attention will be surprised when these 5 companies stop holding up the index. Look, these are all great companies, but at some point, investors are not going to pay 30 times earnings, 40 times earnings, 130 times earnings for Amazon, as an example. When the rotation out of these companies starts, a lot of investors are going to be caught off guard if we don't see a pickup in some of the other sectors and other companies to lead the way. So what changes did I make in the face of such a strong quarter? As you may recall, last month I began reducing my stock exposure in my core equity portfolio toward the later part of May. And by the end of May, I had built up my cash position to about 42%. As the market continued to peak around June 8th, I further decreased my stock holdings in favor of alternatives and added to those alternatives throughout the month. So that by the end of June, I held about 36% in stocks, 25% in alternatives, and 39% in cash. The 36% in stocks is primarily all tech exposure. But if you do want some more details on the specific holdings, again, just send me an email and I'll be more than happy to share it with you. So why am I still defensively positioned going forward? There are 5 primary reasons I have concerns that I have in the coming month or two. And first, the additional $600 of weekly unemployment dollars that the federal government gave is about to expire at the end of July. This money has allowed a lot of people to actually make more money while they were on unemployment than they would have while they were working. Once this stops, I think a lot of people are going to be a little shell-shocked, and it will definitely impact their spending behavior. Second, the forgiveness period for the PPP loans, it's upon us. For companies to receive forgiveness, they need to show that they maintained or increased hiring. This, by definition, means that many companies have deferred layoffs until they receive that forgiveness, and I would expect layoffs to increase once these companies do receive that forgiveness. The huge employment numbers over the last 2 months were good to see, but I believe are a result of these PPP loans and have forced companies to do that rehiring and or possibly even limit the number of people they lay off. This is certainly going to change this month as well as next month, so it's something that we need to keep an eye on. Third, we are starting to see upticks in positive COVID cases. This is increasing the pressure on certain states to step back and limit the reopening of their economies. It's still too early to say, but my expectations are that some of these large states are going to start slowing the reopening quite a bit. New York, California, New Jersey, Connecticut, and even Texas have all begun to take some steps to slow the reopening. And then finally, very little is being reported on the level of bankruptcies. Chapter 11 business bankruptcy filings, they're up 26% in the first half of this year over last year, and with over 3,600 companies filing. Clearly, companies are being affected by the shutdown, and any step back from the reopening of our economy is only going to increase those numbers. Look, I'm very, very happy to see that the market rebounded strongly in the second quarter, and I think this gives investors the ability to reallocate their investments, maybe take some risk off the table, and even just quite candidly just breathe a little easier. But there's still some choppy waters ahead of us, especially in July and August. The Fed has pumped trillions of dollars into the markets. They claim that they did this so that the financial markets can function correctly. Well, if you, the Fed, is the backstop to everything, the markets are not functioning correctly. For markets to work, they must have price discovery. And the Fed has manipulated the process by buying corporate bonds, injecting liquidity to use by speculators, and has fueled overall risk-taking. I think most of you have heard the old saying, if there's no risk, there's no reward. Well, if the Fed removes all the risk, what's your reward? What's going to happen when the almighty Fed decides that they don't want to be printing money at the pace that they are? I just don't want anybody to be stuck at the party and be the last one holding the bag. Right now, the market is trading on a lot of hope. There's hope that a vaccine will be developed, hope that the Fed can solve all economic problems, hope that the federal government will do another stimulus package, hope that corporate earnings will return to normal. Look, we've said this in the past, hope is not a strategy. And if you're blindly investing in that hope, don't be surprised when your hope is not realized. Each day that goes by with the stocks becoming more and more expensive, coronavirus cases increasing, states calling for additional shutdowns, etc., the risk to investors increases. I'm not saying that there's a need to run for the hills, but you don't go broke if you take some gains here. The second quarter provided year-like returns. It's just a prudent process to take some of the risk off the table and wait for a better opportunity to invest. I would just generally say, stick with what's working. Tech is acting like almost a defensive sector with some upside potential. Clearly, tech is holding up the overall markets, so stick with it until something changes. And finally, if you can, look for some alternatives that provide equity-like performance, but with less volatility. There are a lot of strategies out there. There are covered call strategies. There's some defensive equity strategies. If you're able to buy some tail risk insurance through the options markets, there's a lot of things you can do. And if you want to know what we're doing here, just send me an email and I'll be more than happy to share it with you. Look, there's an old saying on Wall Street that the market takes a escalator on the way up, but it takes an elevator on the way down. And I just want investors to be careful as they deploy new dollars into the equity markets today. I really appreciate you watching. As always, if you need any more information on anything that I covered here, or you just want information on our investment strategies, just give me a call or send me an email. I wish all of you the very best in the second half of 2020, and I'll be back again next month with another outlook. Thanks again for watching.